Today, I want to present the option trading strategy credit spreads. These are one of the simplest and, in my opinion, one of the best strategies out of all. Credit spreads are vertical spreads, and vertical spreads are characterized by having the same number of long as short options on the same underlying with the same expiration date but with two different strike prices. The two most common and well-known vertical spreads are credit spreads and debit spreads. The difference between these two being that, just like the name implies, credit spreads are open for a credit and debit spreads are open for a debit. In other words, you have to pay to open a debit spread, but you receive money when opening a credit spread. The amount paid or received is also called premium. Credit spreads are an overall short option strategy. In an earlier video, I discussed the difference between overall long and short option strategies. I'll leave a link in the description below for you to check out after this video. In this video, I will present all the relevant features of credit spreads. First of all, there are two different types of credit spreads. There are bull put credit spreads and there are bear call credit spreads. Bull put credit spreads are a bullish strategy, whereas bear call credit spreads are a bearish strategy. This is how the payoff diagrams look like. The orange line shows the payoff of the strategy at expiration, and the blue line shows the payoff sometime before the expiration date. Just like I said earlier, setting up credit spreads is extremely easy and only requires two options. The setup of a bull put credit spread consists of one long out of the money put and one short out of the money put. It is important to say that the short put has to be at a higher strike price than the long put. The setup of a bear call credit spread is just as easy as the previous one. All you have to do is sell one call and buy one call at a higher strike price. The crosses show where these options are positioned. Now let us move on to the profit and loss of these two spreads. As you may have noticed already, as long as the price of the underlying asset stays on the one side of the strike of the short option, max profit will be achieved at expiration. The price of the underlying has to be higher than the short strike for the bullish credit spread and below the short strike for bearish credit spreads. But note that this is only for the payoff on the expiration date. Before maturity, a move in the correct direction will create a profit. On the downside, the loss is capped as well. The max loss will occur if the price is below for put credit spreads or above for call credit spreads, the long option strike price. So credit spread is both a defined risk and a defined profit strategy. But what exactly is the max profit and max loss? If you're trading in a broker platform, any broker will show you what your max loss and max profit will be. If your broker does not do that, I recommend changing broker. It is nevertheless always a good idea to be aware of what influences your max profit and max loss. Therefore, I will show you what your loss and profit depends on and give you an example in a second. Max profit on a credit spread is nothing else than your net premium received minus commissions. Max loss, on the other hand, is calculated by subtracting the net credit taken in from the width of the strikes, that you then have to multiply by 100. The multiplication with 100 is due to the pricing of options. Options control 100 shares of the underlying, but the pricing is still given in at a quantity of 1. For example, when you buy one option for $20, the option's price will be quoted $0.2. On top of that come commissions. To understand these calculations much better, I will give you an example for both the call and the put credit spread. To do this, I will specify the strikes and more of two example credit spreads. The strikes for the bull put credit spread are 93 and 95. The credit taken in is $0.55, so $55. The strikes for the bear call credit spread are 105 and 107. The credit is $0.51 or $51. For this example, I will just ignore commissions as they don't help with understanding. Therefore, max profit is equal to the net premium, so $55 and $51. Now all we have to do to find out the max loss is put in the given numbers into the calculation. The width of the strikes is 2 for both spreads. So max loss is $149 for the put credit spread and $145 for the call credit spread. The reason why I chose a lower credit for the put spread is because this often is the case, as prices tend to fall faster than they rise. Now the only point left to find out is the break-even point. Luckily, it is very easy to find this out. All you have to do is subtract or add the credits taken in to the short strike. You have to subtract it for the put spread and add it to the short strike of the call credit spread. Out of these calculations, you can partly see that the further your strikes are apart, the bigger the max loss and max profit will become. These calculations may seem complicated. Therefore, you can be happy about the fact that you practically never will have to do them yourself. Once again, your broker should always show these numbers. As you can see, max loss is much higher than max profit. Therefore, this strategy may seem like a rather bad one. But the bad risk to reward ratio gets compensated by something else which I want to present to you in a second. Let us speak about the market assumption for credit spreads now. Before, I already mentioned that the put credit spread is a bullish strategy and the call credit spread is a bearish strategy. But this is only half of the truth. Credit spreads actually are a neutral to range bound strategy. If you take a closer look at the payoff diagram of a call spread, you can see that the price of the underlying ideally should move down. But if the price moves up, you can still make money. The price just shouldn't move up and beyond the strike of the short option. Even if the underlying price stays exactly the same, the spread will still end with max profit. This means if the underlying price stays in the green range, max profit will be achieved. The same goes for a bear call credit spread. They have a big profitable range as well. So the price can either move in one direction, stay the same, or move a little in the other direction. This big profitable range makes credit spreads a very high probability strategy. Therefore, the directional assumption for a good credit spread doesn't really matter a lot, because the price of most underlyings won't move that far anyways in most cases. Therefore, the bad risk to reward ratio isn't actually that bad. The further the options are out of the money, the higher the probability of profit becomes. Good option brokers even show you the probability of profit for your option spread. The next and final aspect of credit spreads are the Greeks. If you don't know what the Greeks are, I highly encourage you to check out my video on options pricing, where I present all the Greeks as well. The short option of credit spreads should always be closer to the underlying price than the long option. So it's basically closer to at the money. Therefore, it will have much more value and thus be more dominant. This is the reason why credit spreads are an overall short option strategy. Due to that, the Greeks of the short options are the ones to look at. I explained this table in some of my previous videos. Basically, it shows the impact of the Greeks on different option positions. As the short options are the dominant ones in this strategy, we can neglect the Greeks for the long options. Delta measures the change of the options price for a $1 move up in the underlying. So obviously, a short put will profit from a move up and a short call will lose value from that move. therefore the plus and the minus. The impact of the remaining Greeks is the same for both short options. Vega measures the change of the option's price for a move in implied volatility, or IV. A minus indicates a loss of value in short options for a rise in implied volatility. This also means that short options and credit spreads profit from a drop in implied volatility. Therefore, it is ideal to open credit spreads in times of high implied volatility. Theta, also known as time decay, is a very important measure. It measures the change in the option's price for time passing by. So a plus symbolizes a gain. This means that short options and credit spreads profit just from time passing by. For these positions, time therefore is literally money. The amount of time decay doesn't change in a linear way and becomes higher the closer you get to expiration. In other words, the amount that the credit spreads profit from time decay becomes larger closer to expiration. The last relevant Greek is gamma, which measures the rate of change of delta. A large gamma means that delta will change very rapidly and that the option's price will lose more and more of its value for every $1 move in the wrong direction. Furthermore, the profit for every $1 move of the underlying in the correct direction will become smaller and smaller. Gamma increases the closer the positions are to expiration. In other words, a credit spread can lose value much quicker closer to expiration. Rho can be disregarded for now as it is only relevant for very long-term option positions. Now let us look at some example credit spreads from my trading. I've picked 3 different ones that hopefully can give you an idea of the versatility of credit spreads. The first example is a bear call credit spread in SPY, an ETF tracking the S&P 500. Back then, SPY was trading for circa $244. I chose the strikes 248 and 250. The blue line represents the short strike, so $248. If the price is below that line, the position will reach max profit. If it moves up and beyond that price level, the position would end at a loss. The 2 blue circles are my entry and exit point. The reason why I chose this example is because you can clearly see that the underlying price moved against me. Nevertheless, the credit spread ended up being profitable. I closed it at the next bigger move down. This really shows the high probability aspect of credit spreads. The entire price area below the blue line is max profit for that credit spread. My next example is another bear call credit spread in IWM. This time my strikes are 134.5 and 144, so a very narrow credit spread resulting in little credit and little risk. This was a credit spread that I closed already after very few days as my profit target was reached. I entered the position a few dollars out of the money. The price fell immediately and a percentage-wise big profit was achieved. But even if I hadn't closed the position then, the position still would have been in the profitable range for another month or so. My final example is a bull put credit spread in QQQ. My strikes were 43 and 41. At entry, QQQ was trading at around $44. As visible, the price moved against me a few times, but the position was still closed for a profit. As credit spreads are limited risk strategies, I rarely close them at a loss if there is enough time left. Just like here, it is often the case that the price will turn around and return to the profitable zone. Last but not least, I want to give you some of my personal tips that I use and that I learned from my trading so far. Credit spreads are, in my opinion, a very good option strategy, and in fact, they are one of my favorite strategies out of all. They are suitable for almost any trading account, no matter the size. Bigger accounts can increase the width and trade them on larger assets, whereas people with smaller accounts can trade them as well. Credit spreads are an amazing strategy for high probability option selling, and I usually recommend trading around a probability of profit of 70%, but feel free to experiment with this. Obviously, you should only open credit spreads for credit, and it is best to sell and buy only out-of-the-money options, for credit spreads at least. But don't go too far or too little out of the money, as this can lead to very small credits. From my experience, I've learned that taking in too small credits can lead to bigger problems as well. So as a rule of thumb, it is a good idea to always take in at least $25 of credit, but the more the better. For bigger spreads with more credit taken in, I recommend closing the position at 50% of max profit. If 50% of max profit gets reached within a very short time, it is often not worth the wait for the remaining profit. Furthermore, you should ideally always open credit spreads in a high implied volatility environment. As reference, you could use IV rank. IV rank tells you how high or low implied volatility currently is compared to historical figures of an asset. Finally, I normally open credit spreads around 30 to 45 days before expiration, but it's also a good idea to change this up sometimes. If you want to learn how to specifically set up credit spreads in a broker platform, you can click here or check the description for a link. I really hope that you enjoyed this video and learned a lot. If you want to learn more about credit spreads, other option strategies, or just trading in general, you can check out my website, tradeoptionswithme.com. I only offer 100% free education on options, the market, and more. Hopefully I'll see you there. Thanks for watching. If you want to see more educational videos like this one, make sure to like and subscribe. Otherwise, tell me what strategy you want me to present next in the comment section below.